Silver just posted a 65% gain in a single month. That is not a strong month. That is a statistical anomaly so rare it has only shown up twice in the last 52 years. February 1974, December 1979, and now January 2026. 3 sightings across half a century. And the reason you need to take this seriously is simple. Both prior times, silver did something dramatic after the 65% month, but the outcomes were completely different. One path created generational wealth. The other path trapped investors in a multi-year purgatory and then detonated into a historic blow-off that punished late buyers for decades. So if you're staring at a silver chart right now and you feel either invincible or sick to your stomach, I need you to slow down and listen. Because the next 60 days may decide whether this move becomes a staircase to a higher regime or the kind of parabolic climax that ends in a liquidity event and a policy crackdown. In a few minutes, I'm going to show you the one question that separates the 1974 outcome from the 1979 outcome. Most people never ask it. They just watch price, and price is the last thing you should be watching in a regime shift. Welcome back to the Dollar Watch. We don't do hype. We do the hidden economy, the incentives, the market structure, the historical analogs, and the systemic risk that gets buried under green candles and political talking points. Subscribe if you want the follow-up to this video, because if this pattern continues into February, the tactical decisions get very real, very fast. Now let's define what just happened in plain English. A 65% monthly move in silver is not normal volatility. It's a parabolic signature. It's the kind of move you typically see when positioning becomes one-sided, when leverage enters the chat, when the marginal buyer stops thinking in fundamentals and starts thinking in fear. Fear of missing out, fear of currency decay, fear of not owning real assets when the paper system starts grinding. A parabolic move is not just price going up, it's price accelerating upward. The curve tightens, pullbacks get shallow or disappear. Every dip gets bought faster than the last. It feels like gravity shut off. And that's why parabolic moves seduce intelligent people. The chart starts rewarding impulsiveness. It trains you to believe risk management is for cowards. Then, when the music stops, it doesn't stop politely. It stops with air pockets. It stops with margin calls. It stops with forced liquidations where the bid evaporates and the only support is how much pain the market can tolerate before policymakers intervene. That is why we have to talk about 1974 and 1979, not as nostalgia, but as case studies in how the silver market behaves when it enters a rare acceleration regime. Before we go back in time, I want to plant an open loop you should hold in your head. The price pattern is only half the story. The other half is the policy response. What the central bank does next, what the exchange does next, and what the Treasury does next will determine whether this becomes a blow-off or a consolidation. We'll come back to that because that's where most retail investors get blindsided. They trade the chart and ignore the referee. Let's go to the first historical instance, February 1974. To understand 1974, you have to understand what happened to money a few years earlier. In 1971, the United States effectively severed the last meaningful link between the dollar and gold. That wasn't just a technical monetary decision. It was a regime change. It meant the world's reserve currency was now backed primarily by political credibility and the productive capacity of the U.S. economy, rather than a hard constraint. When you remove the constraint, governments tend to discover they enjoy spending without restraint. Deficits become easier to justify. Monetary expansion becomes easier to normalize. And inflation becomes a political problem that arrives with a lag, which is why policymakers always underestimate it at first. By 1973 into 1974, the world was dealing with the aftershocks of that transition, plus an oil shock, plus geopolitical instability. Inflation expectations were rising. Trust in the purchasing power of the dollar was weakening. In that environment, gold and silver don't just rise because people like metals. They rise because people are seeking a store of value outside the policy machine. So in February 1974, silver rips, about 65% in a month. the same magnitude we just saw in January 2026. The psychology at the time was familiar. People expected continuation. They expected a straight line. They assumed the move itself proved the thesis. But what happened next in the 1974 case was not a cinematic crash. It was something more psychologically destructive for the average investor. Silver stopped rewarding attention. It chopped. It consolidated. It went sideways for years. This is the scenario almost nobody plans for, because it doesn't feel like danger. It feels like boredom, and boredom is the silent killer of good positions. People don't always sell because they're scared. Sometimes they sell because nothing is happening, and they decide the thesis must be wrong. They rotate into whatever is moving. They chase performance. They abandon the trade right before the next phase begins. In other words, the 1974 pattern was not an instant punishment. It was a slow test of conviction. 5 years of price action that made you question your intelligence. 5 years where the financial media lost interest. 5 years where your friends told you you missed the moment. 5 years where holding felt like dead money, until the late 1970s breakout reignited the move and led into the mania phase we now associate with the Hunt Brothers era. So the first outcome after a 65% month is not necessarily a blow-off and collapse. It can be consolidation. It can be the market digesting an upward repricing and building a new base, while it quietly transfers inventory from weak hands to strong hands. Now let's go to the second historical instance, December 1979. If 1974 was the early era of floating fiat with inflation anxiety building, 1979 was full-blown inflation panic. This is where the atmosphere gets darker, and the market starts behaving like a political referendum. By the late 1970s, inflation in the United States was not a headline. It was a lived experience. People watched wages lag behind prices. They watched energy costs surge. They watched confidence fracture. And when confidence fractures, capital does something primal. It looks for shelter. This is also where the Hunt brothers enter the story. They were wealthy Texas investors who accumulated massive silver exposure. Their actions became part of the narrative. Some call it a corner. Some call it an aggressive hedge against fiat debasement. But regardless of your moral judgment, their presence mattered because it tightened an already tense market. In December 1979, silver posted another roughly 65% monthly gain. Again, the same statistical event. But in the 1979 case, the parabolic phase didn't pause. It accelerated again. The following month, January 1980, silver surged another roughly 35% to 40% into the peak around $50. And then the system pushed back. This is the part retail investors forget, and it's the part that matters right now in 2026. The most violent tops are not created by natural selling. They are created by forced selling plus rule changes. Margin requirements get raised. Position limits get tightened. Exchanges shift to liquidation-only conditions. Credit lines get pulled. The market's plumbing constricts precisely when everyone needs liquidity the most. The result in 1980 was a collapse that wiped out leveraged participants and scarred the market's collective memory for decades. That $50 zone became more than a price level. It became a psychological mass grave. For roughly 45 years, it functioned as structural resistance, an invisible ceiling made of trauma. Even when silver approached it again decades later, the memory of 1980 shaped behavior. People remembered that the last time silver went vertical into that zone, the elevator cable snapped. So the second outcome after a 65% month is the nightmare scenario, a continuation spike that lures in late money, followed by a crash that can take years, sometimes decades, to fully repair in real terms. Now we're in January 2026, and we've just printed the third 65% month. This is where we stop being historians and start being strategists, because we're now at a crossroads that only appears once or twice in a generation. And most investors are blind to the nature of the fork in the road. They are staring at daily candles, reacting emotionally, and letting the market harvest their impulses. Here's the immediate question everyone wants answered. Does January 2026 rhyme with February 1974 or with December 1979? If January 2026 is the analog to December 1979, then the historical template suggests a high probability window for a continuation month, something like an additional 35% to 40% surge, followed by a topping process or a violent reversal. The math is not complicated, and that's why it's dangerous. If silver is roughly around the $110 area after volatility, a 35% to 40% continuation projects into the $150 to $160 zone. And I want you to understand what I'm doing here. I'm not predicting. I'm mapping a historically observed behavior pattern onto a current regime and giving you a zone where risk asymmetry changes. Because in parabolic phases, you don't lose money by being wrong on the long-term thesis. You lose money by being right too early and positioned too aggressively when the market performs its mandatory leverage purge. Now, if January 2026 is the analog to February 1974, the next phase could be the exact opposite of what everyone expects. Instead of a blow-off, we get a grinding consolidation, sideways action that makes the crowd lose interest, and then, later, a renewed breakout once the market has rebalanced inventory and the macro fuel reignites. So, which is it? Here's the open loop I promised earlier. There is one diagnostic question that does more to separate these outcomes than any chart pattern. Are policymakers about to tighten real conditions? Or are they about to accommodate the move? That's it. That's the question. In 1980, the system ultimately chose to crush inflation psychology. Paul Volcker's Federal Reserve pushed rates aggressively higher. Real yields rose. Liquidity got strangled. And risk assets, especially leveraged positions in commodities, paid the price. In other words, the macro referee changed the rules in the direction of austerity. In 1974, the environment was messy, but the long-term arc was not a clean, sustained tightening regime that restored credibility quickly. Inflation remained a chronic threat for years. The system didn't immediately succeed in re-anchoring expectations. That allowed metals to remain relevant as a hedge, even if price spent years consolidating. So when you ask whether we're headed for 1974 or 1979, what you're really asking is whether the authorities will tolerate a metal-led referendum on currency, or whether they will try to reassert control through tighter policy and market restrictions. And here's why this is so uncomfortable in 2026. The modern system is far more indebted than it was in the late 1970s. Public debt, private debt, corporate debt. This is an era of fiscal dominance, where monetary policy is constrained by the government's financing needs. When debt is high, aggressive tightening breaks things faster. Banks wobble, real estate cracks, funding markets seize, politicians panic. That means the Volcker solution is harder to deploy now, not impossible, but politically and structurally harder, which increases the probability of continued monetary accommodation, whether explicit or disguised. But don't get comfortable. Modern systems have other tools besides rate hikes. They can raise margins, they can adjust capital requirements, they can jawbone, they can apply stability measures, they can regulate access, they can lean on intermediaries, and those interventions can produce 1979-style price violence even without a clean Volcker regime. This is why the next 60 days matter, because in this window, you tend to see the first serious attempts to cool the move, and how the market reacts to cooling attempts tells you whether the move is fragile speculation or a structural repricing. Now let's talk about what a lot of people get wrong when they look at an event like 65% in a month. They assume it means silver is overvalued. That assumption is lazy. Parabolic doesn't always mean overvalued. Parabolic means the market is repricing something faster than participants can adapt. Sometimes that repricing is purely speculative. Sometimes it's a delayed catch-up to fundamental scarcity. Sometimes it's a monetary event where the unit of account is being questioned. The same chart shape can represent three different realities. Your job is to identify which reality you're in. And this is where we need to widen the lens beyond silver and talk about the monetary backdrop, because silver is not moving in a vacuum. Silver is priced in dollars, so when you see silver explode, it can be telling you something about silver, or it can be telling you something about the dollar, or it can be telling you something about both at once. In a genuine currency confidence event, you often see everything go up. Stocks rise, real estate rises, commodities rise, gold rises, silver rises. Not because the world suddenly got more productive overnight, but because the currency denominator is being marked down. People flee cash. They buy assets not to get rich, but to avoid getting poorer. That's why a parabolic silver move can be a monetary alarm bell. Silver is volatile, thin, and reflexive. It overreacts. It becomes a high beta lie detector for monetary credibility. And if that's the regime we're in, then the question becomes less about, is silver expensive, and more about, what is the dollar worth? Now let's bring this back to practical decision-making, because history without action is just entertainment. If the 1979 style continuation happens, if we get that extra 35% to 40% surge, then the $150 to $160 zone becomes a place where you need to think in terms of risk reduction, not maximal aggression. That doesn't mean you sell everything. It means you respect the probability distribution. It means you recognize that blow-off phases can reverse so fast that you don't get time to think. In tops like 1980, the people who got hurt weren't the long-term believers who sized correctly. The people who got hurt were the late buyers who entered because price action made them feel safe, and the leveraged traders who assumed volatility would stay friendly forever. This is where fiduciary duty comes in. Your duty is not to be a hero on social media. Your duty is to protect your capital so you can stay in the game when the market offers asymmetric opportunity. And here's a brutal truth. The market doesn't punish you for being early. It punishes you for being leveraged. A long-term investor who can tolerate volatility is playing a different sport than a trader on margin. If you're trading futures or high-leverage products in a parabolic market, you're not investing. You're renting exposure from the exchange, and the exchange can raise your rent overnight. Now, what if we get the 1974 style outcome instead? The danger there is not collapse. The danger is that you get chopped to death by boredom and frustration. Sideways action with violent swings that liquidate traders and demoralize investors. In that scenario, the winning strategy is usually patience and disciplined accumulation, not constant reaction. But you still need levels, because patience without a plan turns into hope, and hope is not a strategy. Based on the structure described in your source material, you're working with a rough risk envelope. Upside risk into a blow-off zone around $140 to $160 if the continuation month prints, and downside risk into a major support regime, possibly around the $60 to $70 zone, if a deep correction or multi-year consolidation takes hold. Now, I'm going to be careful with absolutes. No price is gone forever. Markets have a way of humiliating certainty, but the idea of a permanently higher floor is not crazy when you have structural industrial demand, constrained mine supply, and a monetary regime that is increasingly dependent on financial repression. In that environment, old lows become harder to revisit because the entire cost structure, labor, energy, permitting, capital, has been repriced higher. This is why you must separate your time horizon. If you hold physical silver as a long-term store of value, your main enemy is not a 10% down day. Your enemy is panic selling into volatility and swapping scarce metal for depreciating currency at the wrong moment. If you're actively trading silver, your enemy is volatility itself. You need to be able to survive 30% drawdowns without blowing up, because silver can do that even in bull markets. If you can't, then your position sizing is wrong, or your instrument is wrong, or your time horizon is wrong. And if you're new and you have no position, the most rational approach in a regime like this is incremental exposure. Dollar cost averaging, scaling, avoiding the all-in impulse that turns investing into gambling. Now let's talk about the psychology that creates the wealth transfer, because this is where most people lose, regardless of whether their macro thesis is correct. Parabolic markets create a loop. Price rises fast. You feel late. You chase. Price drops hard. You panic. You sell. Price recovers. You feel foolish. You chase again. That cycle repeats until your capital is drained and your confidence is broken. Then, right after you give up, the market moves without you. This is not a flaw in your character. It's a predictable human response to uncertainty and social pressure, which is exactly why institutions design systems that monetize it. They buy when the public is scared. They distribute when the public is greedy. They use volatility to harvest emotion. Your fear becomes their entry. Your FOMO becomes their exit liquidity. So I want you to remember one sentence, because it is the simplest summary of how you avoid being the product. Your fear creates bottoms. Your greed creates tops. If you don't have a plan, your emotions will write one for you in real time. And real-time plans in parabolic markets are almost always expensive. Now, I promised you we'd come back to the referee problem, the policy response and market structure response that can turn a bullish thesis into a short-term disaster. In 1980, silver didn't just decide to crash. The environment changed around it. Margin requirements tightened. Trading rules shifted. Liquidity became punitive. That's why you need to watch exchange behavior now. When markets move violently, exchanges protect themselves. They do not protect you. They protect the clearinghouse. They protect the system. So if you want a short list of what to monitor over the next 60 days to determine whether we're heading toward a 1979 blow-off or a 1974 consolidation, watch these. Watch margin requirements and any sudden rule changes. Those are mechanical triggers for liquidation cascades. Watch real rates and the direction of policy credibility, not headline rates. Real rates versus inflation expectations. Silver and gold respond to the opportunity cost of holding hard assets. When real yields are deeply negative, metals become competitive. When real yields rise aggressively, metals face headwinds. Watch positioning and sentiment. If the public is euphoric and leverage is extreme, the system becomes fragile. If the public is still skeptical and the move is being driven by structural buyers, the move can persist longer than people expect. And watch physical market tightness, premiums, delivery behavior, inventory reports, because parabolic moves are sometimes the paper market catching up to physical reality. Other times they're paper speculation outrunning reality. Those are different animals. Now let me speak directly to the decision point, because this is where people want certainty, and I'm not going to lie to you. Nobody can call the top with precision. Not me, not a hedge fund, not a central bank. Tops are processes, not moments. What you can do is identify zones where the probability of a violent reversal increases and where reducing risk is rational. That's not cowardice. That's professionalism. If silver continues higher and approaches the $140 to $160 area on acceleration, that is where you start thinking like a risk manager. Scale some profits if you're overexposed. Reduce leverage. Tighten your plan. Because the market doesn't warn you with a polite email. It punishes you with a gap. If silver corrects hard, the correct response is not emotional capitulation. It's scenario execution. If your long-term thesis is intact, volatility is the admission price. But your size has to match your conviction, and your conviction has to be rooted in data, not dopamine. And here's the darker takeaway that most people don't want to hear. In rare moments like this, the market is not just moving money around. It is reorganizing who owns scarce assets for the next decade. That's why the next 60 days matter. Because this is when weak hands get shaken out, not because they're stupid, but because they're overextended, over-leveraged, and operating without a plan. So here's what I want you to do right now. Don't predict. Prepare. Write down what you will do if silver spikes into the 150s quickly. Write down what you will do if silver collapses 25% in a week. Write down what you will do if silver goes sideways for 6 months and everyone stops talking about it. Because the person who wins the next decade is not the person with the hottest take. It's the person who can hold a coherent strategy through chaos. We've now seen the third 65% month in 52 years. That's not trivia. That's a regime signal. The market is telling you volatility is here to stay, and the old playbook of calm price discovery is being replaced by reflexive, policy-sensitive repricing. Drop a comment with which path you think we're on, 1974 consolidation or 1979 blowoff, and tell me what indicator you're watching to confirm it. If you want a companion deep dive on gold's historical analogs and regime shifts, say gold analysis in the comments. And if you're not subscribed, understand this. The next update matters more than this one, because February is where this pattern either confirms or breaks. Stay rational, stay liquid enough to survive, and don't let a once-in-a-generation pattern turn you into someone else's exit liquidity.